The gold revaluations and inflation. Below was a 66% revaluation. This one would be 60 times larger than that because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see.
And I think gold's response to a real interest rate decline or a couple of 25%, 25 basis point rate cuts, participants in the futures markets or those who look at the futures markets to engineer a short squeeze need to understand that the futures markets are owned by the futures markets participants. And if we had this type of short squeeze, it wouldn't physically settle.
Gold's price action is coiling around a critical level, consolidating near its 50-day SMA and awaiting its next decisive move. Strong support sits in the $3,250 zone, where buyers have repeatedly stepped in to defend the trend. A breakdown below this level would likely send spot gold toward the deeper green zone, a key accumulation area for long-term investors. On the other hand, a breakout above the $3,450 to $3,500 red zone would trigger a sharp upward surge as momentum traders and institutional buyers flood in. The setup is tightening, and the next move could be explosive. Rafi Farber, known as the endgame investor, has been tracking a similar signal beneath the surface. Gold miners, measured by the GDX and GDXJ ETFs, have already begun trending higher since early August, even as gold itself remains in consolidation. Historically, such miner leadership has often marked the end of a consolidation phase, with bullion quickly following higher. If this pattern holds, gold's next breakout could be imminent. The fundamental backdrop is equally compelling. In Washington and Brussels, policymakers are floating the idea of officially revaluing gold reserves, a move that, in the U.S., would mean marking the government's 261.5 million troy ounces from a statutory $42.22 per ounce to current market levels near $3,400. For perspective, this would create an immediate accounting windfall for the Treasury, unlocking fiscal breathing room without printing a single new dollar. Central banks worldwide could follow suit, formally recognizing gold's actual market value on their balance sheets, a shift that would reshape global monetary dynamics. In this video, we dive into Rafi Farber's analysis of gold's tightening technical setup, along with the underlying signals from gold miners, central bank policy shifts, and the looming prospect of an official gold revaluation. So stay tuned. And if you value deep, data-driven insights into gold, silver, and the global monetary system, make sure to like this video and subscribe to the channel for more weekly analysis. We appreciate the support and hope you enjoy the video.
1,295 grams per ton silver at the galleon target, 3.8 grams per ton gold at the horseshoe target. We've got copper, zinc, lead, antimony, gallium, indium, and tin. Rumor has it that Putin will be there soon, and he might take a look at the resources. I don't think he actually will, but it's an interesting coincidence. Now with that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian school positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they're both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed cut rates 150 basis points from Bloomberg. U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points. That is 150 basis points lower than it is now. I think we could go into a series of rate cuts here, starting with the 50 basis point cut in September. That's what he wants. Besson said in a television interview on Wednesday. If you look at any model, whoa, those models got to be hot. It suggests that we should probably be 150, 175 basis points lower. I wonder what model. One thing I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate. The lease rate spread, how much it costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backward dated state. And another word for endgame is permanent gold backwardation. We will get there. And now let's go into gold revaluation. This article came out on August 1st, and it was alerted to me by Craig Hemke, who we will quote in the next slide. August 1st, 2025, official reserve revaluations, the international experience. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Now it's $3,400. So what would that mean? If you read this article, which I'll put in the link in the description below, it's full of a bunch of crap, which talks about some insignificant gold revaluations in the past few decades, but totally ignores the big one in 1933, 1934 of $21 to $35 a troy ounce, and then the big one in 1971 from $35 per troy ounce or $42 per troy ounce to whatever the market says, which was a gold default. U.S. government revalues its gold. Of course, the other governments of the world will revalue theirs, and usually we're talking about the central banks here and not the government. But why do I think that the price of gold will head up higher very fast when there is an official gold revaluation mark to market? Well, here is some of the evidence, and then I'll give a logical explanation. First of all, the gold revaluations and inflation below was a 66% revaluation. This one would be 60 times larger than that because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see these are food prices. I'm going into food prices because I want to know how a gold revaluation, think of it, the simplest one is this, that gold at the Fed on its balance sheet is not convertible. You cannot go to the Fed with your dollars and get the gold that it has in its basement. What you can do is you can buy gold at a coin shop. So right now, the premium for gold at $3,400 is the gold that you can actually hold in your hand. You can go to a coin shop for $3,400, give them the cash, and they will give you an ounce of gold. The gold that you can physically hold in your hand is worth $3,400, and that is the premium that people are willing to pay over the gold that you cannot, which is $42.22. Now, if they market to market, that means that gold that you cannot hold in your hand is worth $3,400. Then therefore, what is the premium gold that you can actually own yourself? Well, we don't know exactly what that premium is going to be, but it's going to be a lot higher than $3,400. And it could take a few days or a few weeks or maybe a month to catch up for the premium to start to rise. But recall that the strongest gold rally in history was from 1971 to 1973, which was even stronger in percentage terms than the rally from 1978 to 1980. Often it doesn't seem that way, thought of that way, but the strongest rally in gold was right after the revaluation or the devaluation of the dollar in 1971. We're going to see something very similar in gold prices if and when there is an official gold revaluation. The other way to think of this in terms of the Misesian regression principle is that all transactions in dollars are based ultimately on promises for gold, because that is how the dollar was born. And because all economic transactions today flow from all economic transactions in the past, it's like thinking about time travel. If you go back in time and change an event in the past, it's going to change all events in the future. So if you change economic events in the past, obviously they will also change economic events in the future. And the economic events of today are still based on the assumption that gold that is owned by the Fed is payable at 42.22 an ounce by dollars, which are the Fed's liability. I understand that people do not actually believe this, but because the economic transactions of today stem from those of yesterday and prices of today stem from prices of yesterday in gold terms, that means if the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation.
While the U.S. Treasury's official gold valuation sits at just $422 per ounce, a figure set in 1973 and far removed from today's market price near $3,400, Rick Rule sees this as a striking example of balance sheet potential hiding in plain sight. Revaluing those reserves closer to market levels could dramatically strengthen the government's financial position without selling a single ounce. Yet, Rule stresses that the first hurdle would be proving the gold in Fort Knox physically exists and hasn't been hypothecated, something Washington has long avoided. Even if such a revaluation occurred, he questions whether it would meaningfully reduce the national debt, noting that inaccessible collateral is of little practical value to creditors. Rule is equally attentive to silver, where annual consumption outpaces new mine production, recycling, and byproduct recovery, a structural deficit often cited by silver bulls as a bullish driver. However, he cautions that massive above-ground inventories, though hard to quantify, remain a counterweight to runaway prices. Despite this, silver has been one of the standout commodities this year, rising roughly 28% year-to-date amid tightening supply and robust industrial demand, a performance that underscores its capacity to outshine peers in the right conditions. Let's get back to the interview.
If the U.S. government took the gold in Fort Knox, well, first of all, they'd have to do something they refuse to do, which is audit it and prove to us that A, it physically exists, and B, it hasn't been hypothecated. But let's say they revalued all that gold from $42 to $4,000 an ounce, just for fun, okay? How does that eliminate the national debt? I, as a creditor, buy a Treasury bond. The government is either able to service that and pay me back, or they're not. Can you imagine Rick Rule rolling up to the White House with my bond saying, listen, President Trump, there's something about this arrears. I'd like my gold. I need to remember that President Trump has a legal monopoly on violence, fraud, and force. The fact that they revalue collateral that a lender can't access is of very little interest to anybody. It becomes an accounting entry. The amount of gold that they have doesn't change. The creditor's access to the gold doesn't change. The only thing that changes is financial ledgerment. If I have a piece of collateral, Dunnigan, and you can't access it, effectively it isn't collateral. And that's the way it is with the government's gold. Yeah, absolutely. I remember well the bull market of the 1970s. Those were my formative years as an investor. In that decade, 1970 to 1980, the purchasing power of the U.S. dollar, according to the then Office of Management and Budget, declined by 75% in 10 years, and the gold price ran 30-fold. A truly memorable bull market. In the middle of that bull market, many people forget that in 1975, there was finally popular outcry against inflation, and Congress and the Fed decided that they were going to break the back of inflation and increase the interest rate. They did that, and the gold price fell from $200 an ounce to $100 an ounce, and the then Philadelphia Gold and Silver Stock Index fell by 65%. And it did it in 10 months. It was a precipitous decline. If you were a young man with a quarter of his net worth in gold and gold stocks, a guy named Rick Rule, it's important to know, though, at the end of that period in 1975, because it wasn't just the gold market that got impacted. The stock market sold off. The bond market got obliterated. Housing starts basically stopped. Consumer durables that are financeable like automobiles fell apart. So Congress lost their nerve in a hell of a hurry. And when they took the interest rate down at the end of 1975, savers and investors in the United States and around the world understood that U.S. society capitulated in terms of keeping the dollar strong. And people who got shaken out by that 50% decline in the gold price missed out on a move from $100 an ounce to $850 an ounce in 5.5 ensuing years. I'm interested in this question because I think the political pressure in the United States right now is around another concerted interest rate drop. And that interest rate drop, given the strength in our economy, particularly relative to other economies, will signal to investors and savers around the world that U.S. society and the U.S. government is uninterested in protecting the integrity of the U.S. dollar. And I think gold's response to a real interest rate decline or a couple of 25 basis point rate cuts could be dramatic. Truly dramatic. Maybe not as dramatic as 1975 was, but truly dramatic. If you look at the amount of silver that's consumed every year relative to the amount of silver that is produced from silver mines or is a byproduct of other metals or is recycled. And frequently the silver bulls suggest that this deficit is so overwhelming that the silver price has to move. What those bulls neglect to point out is there's several billion ounces of above ground silver in inventory that doesn't have to be mined. Silver, unlike gold, is used. It's important to note that it's used in, for reflective capabilities, as an example, in solar industry. It's used in microelectronics, in regular electronics. It's also increasingly used as a germicide and in water treatment facilities. And a bunch of silver every year, goes out a tailpipe or goes up a smokestack or something like that. It goes to silver heaven. More silver every year right now is getting used than is getting produced. But there are enormous stockpiles of above ground silver. And nobody really knows how much. I remember back to the 80s when Buffett suddenly announced that he owned 15% of the reported above ground stocks of silver. The silver price promptly doubled. All the short squeeze guys, even in the 80s, came out from under their bridges or wherever they were. And all of a sudden the silver price collapsed. And all the silver bulls were saying, well, this must be manipulation. This must be J.P. Morgan Chase trying to screw me. What it was that there was a whole bunch of physical silver owned by the Indian peasantry. The silver price doubled in U.S. dollar terms, and the U.S. dollar doubled against the Indian rupiah. At the same time, I forget if there was a flood or a drought, one or the other. But there was a bad harvest in India, and the Indian peasantries had to make a choice between selling an asset class that was up by 400% or allowing their kids to starve. Pretty easy decision. So in the context of the question that you asked, both parts are right. There is a structural deficit in terms of new mine supply or newly created supply relative to industrial demand, but there are enormous above ground inventories. The experience of Sprott, going back to 2014, 2015, the silver squeeze, is instructive. The narrative around silver was in full swing, and the easiest way for American investors to express their sentiment was the Sprott Physical Silver Trust. We as Sprott were able to use an at-the-market financing mechanism to convert this market activity into cash, which we used to buy silver. And for a while, we were raising $40 or $50 million a day. And our charter prohibited us from taking depository receipts. We had to take silver. So we couldn't hang around and try and buy that silver at the best price from the best taker. We cleaned out the silver that was available to us in Toronto. We cleaned out the silver that was available to us in Ottawa. We then cleaned out Chicago. We then cleaned out New York. Sidebar, gold is expensive and easy to transport. Silver is not expensive and it's tough to transport. And the people who owed us the silver, the J.P. Morgan Chases of the world, had to charter these very large airplanes to fly physical silver to us from Switzerland and London. Now, it wasn't that the silver was unavailable on a global basis. It's that the silver was unavailable where it was needed. And that goes to the futures markets. It's very common, Donegan, we've talked about this on your show before, because the futures markets are so liquid, because they trade such amazing volumes, it is not uncommon to see a single 24-hour period trade more trade 200 times the physical silver that's available for good delivery. Now, invariably, these things cash settle. But if you thought about a very small amount of the futures transactions that was held for good delivery, that would absolutely overwhelm the futures market. Participants in the futures markets, or those who look at the futures markets to engineer a short squeeze, need to understand that the futures markets are owned by the futures markets participants. And if we had this type of short squeeze, it wouldn't physically settle. What would happen is that the exchanges would do what they did with tin. They would halt transactions, they would arbitrarily establish a price, and they would cash settle. That's what'll happen.
Rafi Farber sees the current gold market as one where physical supply tightness is no longer a theory but a measurable reality. Indicators such as strong mining results, miners outperforming bullion, record high lease rates, and narrowing futures spreads all signal mounting pressure in the physical market. Adding to this are policy factors. The U.S. pushes for aggressive rate cuts and renewed talk of revaluing gold from $42.22 to about $3,400 per ounce, a shift 60 times larger than in 1933. Based on history, such a move would likely trigger sharp gold price gains, parallel revaluations by other central banks, a devalued dollar, and significant inflation, a sequence markets have witnessed before. Rick Rule sees silver as having strong upside potential but with complexities that make it a challenging trade. While annual demand exceeds new supply, vast above-ground inventories can quickly enter the market, as seen in the 1980s Indian silver sales. Combined with logistical issues, regional shortages, and a futures market that is far larger than the physical supply, a traditional short squeeze is unlikely. It would likely be resolved through exchange intervention and cash settlement. Significant price gains would require both physical tightness and investor sentiment strong enough to overcome these obstacles, a combination that could still lead to explosive moves. What would happen if the U.S. suddenly revalued its gold reserves from $42 to $3,400 an ounce, and silver demand kept outpacing supply despite massive above-ground inventories? If you found this breakdown valuable, please like the video, subscribe, and share it with other serious investors who need to hear this. Thanks for watching.